Despite almost nobody thinking they would, interest rates have been in a free fall lately. The yield on the 10-year Treasury note touching its lowest level in nearly 2 years. And that precipitous drop could have a major impact on your money. So all this week, we are digging in on the rate shock and breaking down how it impacts your biggest investments. And today, we kick off our series with a look at what is behind the big drop in rates. Steve Leisman has some answers.
3 reasons behind the latest downdraft in bond yields. First, inflation has consistently come in below the Fed's 2% target, and it looks to be falling further. Second, growth is expected to weaken, maybe a lot, depending upon how new tariffs on China and Mexico play out in the broader economy. Third, low inflation and weaker growth are forecast to combine to prompt the Federal Reserve to cut interest rates. How much have rates fallen? From the presidential election in November 2016 to the peak of rates under President Trump, the benchmark 10-year yield rose by 140 basis points, call it 1.4 percentage points. Well, since November 2018, yields have fallen 115 basis points, so that just about wipes out nearly all of the post-election increase. It's been a powerful bond rally, but it will need to be confirmed by powerful actual economic weakness, low inflation, and Fed rate cuts to be sustained.
And our thanks to Steve Leisman. So there is your macro setup. The question is, where do rates go from here? Joining us now is Sri-Kumar, president of Sri-Kumar Global Strategies, live from Los Angeles. We know it's a big day. We get you on live in LA, Sri. Here's the thing. I said almost nobody had called for this downturn in rates. You and some of the other Southern California bond mafia, if you will, you guys got it right. What did you, Sri, see that led you to believe that rates not only have fallen, but that will continue to fall from here?
The reasons, Brian, are first of all that this is not a short-term issue. This started from 2008 onward. It was clear to me at that stage that the way in which the quantitative easing was done and we went for zero interest rates for a long period of time, we were not going to have a growth recovery. Second, the way in which it was done, wage increases have been minimal, stock increases have been phenomenal, and the wage earners are the consumers, and the consumers have been deprived in this economic recovery. Those are 2 major reasons, and that has not changed, Brian. Until that changes, I look for rates to continue to go down further.
You know, all this week, we're going to hit this story from a lot of angles: consumer, corporate debt, housing. We'll get to housing later on in the week, but if our viewers are out there maybe thinking about taking a major loan for something, do you believe rates are going to continue to drop from here? Could we go below 2% on the 10-year?
I'm looking for the 10-year to go well below 2%, even though the yields have gone up today as a result of the Mexican trade deal being achieved. As you said a few minutes ago on your program, Brian, the president can reimpose tariffs at any point in time, and the Mexican deal is also at risk if the Democrats do not approve of a USMCA or NAFTA 2 in the House. So for both of those reasons, you have that risk still there. You have the China trade risk that the tariffs may be imposed. All of this says to me that you want to hide in a safe haven, and the yields are going to go down further. So for your viewers who are watching, do not be a market timer. If you are looking for a mortgage, 10-year, 30-year mortgage, you are at a great rate right now. You may not want to wait for the absolute bottom, but this is a very good time to go and do it.
You know, and also there's been this talk, Sri, about, well, China could dump our treasuries as some kind of a punishment for the trade fight. Most people think that they wouldn't. But there's been so much activity buying bonds. Who exactly do you think are the buyers of treasury debt?
That's a great question, Brian. If the Chinese were to dump treasuries, which I don't think is going to happen, if they do, that would amount to such a big increase in global risk that the private sector demand for holding treasuries will more than offset what the Chinese are going to dump. So once again, as I've been saying on your program in the past, counterintuitively, if the Chinese dump treasuries, the treasury yields will go down, they won't go up.